Hi, everybody. And as you will have read in the email and the monthly update that I sent out, we have Louis Christopher with us today to give us an update on the annual boom bust housing report that Louis produces around this time every year. And as it was coming up to writing this monthly edition, and I was thinking, what can I write about? And I have a lot of emails that come into me from subscribers wanting to know what's going to happen to the housing market, because we've had forecasts of 20 to 30% median price falls in the national median from the major banks and from peak to trough. So, they're forecasting that that's going to continue through 2023. That's not what I'm forecasting, as regular readers will be aware. But I think that the most accurate forecaster out there for short-term percentage price predictions is Louis Christopher. And the reason I say that is because of the accuracy. I mean, I've been following Louis for a number of years, obviously known you for a number of years, Louis, because I know you there. But you've been incredibly accurate with your forecasts, more accurate than any of the major data providers, CoreLogic, the REIA, Domain. And so I'm fascinated. I don't know. At the time of this interview, and hi, Louis, I have no idea what your forecast in the boom bust report is. I looked on your website. I saw, okay, this is going to come out on the 29th. CTNF has to go out on the 30th. So I'm recording, reached out to you, obviously called you on the phone and said, help. Let's get like a prelim of what's coming up next year and just see whether, you're seeing the same things that I'm seeing and what's going on. So first of all, welcome. You're looking amazing, by the way. I haven't seen you for a while, but I did. You put a tweet out saying you've been on some kind of diet app or something.
Yeah, I put it on Facebook. And look, hey, nice to be with you once again, Catherine, and your audience as well. It should be a good chat today. That's nice of you to pick up. Yeah, I've been battling the weight for some years now, and I got to the point of almost giving up, and it was like I couldn't give up. So I tried this app called Noom, which I know has been advertised a lot, and this is certainly no advertisement from Noom. They're not paying me. I managed out of that app to so far lose 11.5 kilos to date, and I'm still on it, and I'm very happy for it. I'm definitely sleeping better. I'm breathing better. I'm more functional. And still got a little bit more to go to get to my optimal body weight, but very, very happy that I've managed to actually get a result. And look, hey, if I can get a result out of this app, then I think maybe potentially a lot of people can, because I was at the point where I'd almost given up.
Oh, really? Look, it's hard when you do a job where you're not on you're kind of sitting behind a computer all the time, because that's the issue that I have as well. It's difficult to keep fit and to keep on top of your diet.
The keeping fit's a critical part. And look, quite frankly, I hate gyms. I don't know about you, but gyms have never worked for me. But doing the steps, walking, trying to as part of this, do at least 7,000 to 10,000 steps a day, every day. Has definitely helped as well. I work out at home. I've been doing that for a long time. I'm a little bit of a health freak with it, but it does make you feel better for sure. Yes.
But let's get on to the nitty gritty of what's happening. So I don't know whether to start. I actually kind of don't want to start right now with saying what you're going to see coming up ahead.
Yep.
I'd like to go back to the last couple of years and kind of what we've seen in that, because your 2020 forecast came out and you obviously wrote that at the end of 2019. None of us knew that a pandemic was about to hit and what consequences that would have. Still, the forecast kind of held up right through 2019, because that started around mid-year. Obviously, we started one of the fastest growing property booms we've seen historically, certainly in recent history.
That's right. Yeah, so going into COVID, the market was in recovery. It started its recovery essentially from the 2019 federal election. Recall how negative gearing was a big issue for 2019. And so one of our forecasts was that, the Libs will win that one that year, and we would actually start to see a recovery in the market, and that played out. And 2020, we believed that would still continue to play out somewhat. So yeah, and then 2022. So for our forecast for 2022 was that the housing market would record some falls. And at the time we released it, I recall distinctly the banks were like, no, we're going to have prices going up in 2022, and they all wound those forecasts back from, if I recall, from about the March quarter through to the September quarter of this year. But it was, we believed that, look, inflation was not going to be transitory. You may recall the RBA saying, look, the cash rate was going to stay on hold till 2024, and that inflation was transitory, but we were seeing signals there to suggest actually inflation was going to be with us for a lot longer, and that the RBA would have to respond to that. And yes, of course, we didn't forecast the Ukraine war, so those are the type of things which, hey, if I started forecasting that, I think you better burn me at the stake or something. But look, it's a matter of just looking at all the various indicators. One good thing that always helps in forecasting for housing is that I generally find a housing market is not as choppy as what you see in the equities market, up one day, down the next. It's a little bit more momentum behind it. So you have a little bit more time to actually work out these things somewhat. And as your readers may well be aware, what I like to do is run with, say, 4 main scenarios. Because, okay, I'm a housing market forecaster. We also do many other things at SQM, but I'm not a forecaster of interest rates. And I can't read the mind of the RBA governor, nor his board. And so what we like to say is, okay, well, look, hey, I may not know for sure where the cash rate's going to end up in 2023, but if it ends up at such and such a level, then this is what's likely to happen to the housing market. And that's how I generally like to view the world. We know that definitely cash rates, inflation, population growth, overall income, unemployment, these all impact upon housing markets to various magnitudes across the country. Some areas more so than others, but they all have an influence upon the housing market.
And, I obviously, well, first of all, the 2022 forecast in that respect, because in your forecast, you have scenarios.
That's right.
It's very easy. So you've got your kind of baseline scenario, and then it's, here are the possibilities. And if these possibilities play out, this is going to be the likely effect on the property market. And for that forecast, which again was incredibly accurate in terms of saying we're heading for a peak, right? Probably early year. And
that was the primary call. We're heading for a peak. And I think I was the first to come out to say we're heading for a peak. The base case was that housing prices would fall modestly to moderately, and that the RBA would be largely on hold for the year, but they would eventually have to lift rates. Our fourth most likely scenario was that the RBA would have to lift rates prior to mid-year 2022. And on that scenario, the forecast was that the housing market would fall somewhere around 8 to 10% for the year. And that's what's played out.
Yeah.
That was our fourth most likely scenario. For 2022, we actually started with a universe of about 20 scenarios, and we narrowed it down to 4. And that was number 4. Yeah. So this year, we actually had about a universal scenarios of about 10 scenarios that I spent time trying to work out what it would mean, that we worked from. And once again, we've boiled that down to 4 scenarios, which, they're pretty line ball in terms of what they're going to play out. I must say I don't have a lot of confidence on my base case, but out of the 4, I think it's the one that's got the highest individual probability. Yeah.
So I kind of, before we get onto that, I sort of want to take a review of what happened through this year, because I'm obviously working on the ground, so I kind of see it from what's occurring. I feel like I see things that are happening in advance because I'm monitoring the stock on the market every day within I cover a large area. Seeing what buyers and sellers are saying, seeing obviously what clearance rates are doing, getting kind of like a feel for it. We spoke, I think it was April in this year, just when the rate hiking cycle had started. And neither of us, and I don't think anybody else, would have foreseen that the bank was going to hike the cash rate as fast and hard as it did. And obviously that shocked the markets. And when we got to mid-year, things didn't look all that great on the ground. There was a lot of fear around. There was a lot of uncertainty. I did a few vendor advocacy jobs. So I was helping a couple of people that were selling at the time, had to discount the prices quite substantially. And that was because people were turning up at auctions, waiting for the properties to pass in because they didn't want to go in with an offer that wasn't subject to finance. Things have improved since then. Things don't look anywhere near as bad right now as they were looking mid-year. And there's a lot of indications for me, the stock is turning over a little bit faster, particularly in the 500 to 800,000 price bracket. There seems to be a little bit more confidence out there. But what's your take been on, since we had that conversation and you were saying inflation is coming, invest in real assets, don't go into too much debt, but find yourself an affordable property, rents are rising, this is what's going to happen. What's been your take over the second half of this year? What have you kind of gauged from what's happened?
Yeah, well, I think you're absolutely spot on that. Look, at the beginning of the year, if you were to say to an analyst, to myself, for example, that, look, hey, the cash rate's actually going to go up by, to 2.85% and more, what's your forecast for the market? We would have likely said, look, hey, it's going to be a big fall. It's going to be bigger than what we've had. And so we need to understand, well, okay, why hasn't it been as big a fall as what everybody would have thought, given, say, at the start of the year, a cash rate of 2.85%? And that's to do with inflation. It's to do with the rise in wages and the rise in the small business income. The total rise in what I call nominal GDP. Well, it's a technical term, nominal GDP, which has risen by 12%.
Yeah.
And we've found over a long period of time, there's a strong relationship between nominal GDP and housing prices. And historically, people have been looking, when in times of higher inflation, people look for real tangible assets to get a hedge against that inflation. And real estate's definitely one of these key assets that people want during higher inflationary times. And that certainly played out in the 1970s, where, for example, we hit at one point an inflation rate of 17.5% in this country. And Sydney housing prices actually quadrupled during that decade. Quadrupled, risen fourfold. I mean, it was just insane. There are some differences between those times and now. One of the big differences, of course, is household debt to GDP. It's running at essentially 123%. And so there is a very strong argument to say, okay, that debt is meaningful. The serviceability of all that debt out there is something to be reckoned with higher interest rates. The key in all this, though, is what happens to incomes and whether wages actually pick up. And wages have been picking up to an extent. And definitely, as mentioned before, small business incomes have been picking up. And it's evident in the housing market itself through rents. Rents, of course, is a key income for investors. And we all know what's happened in the rental market. So, the reason why we didn't have the big crash is because of this pickup in inflation. And so therefore we need to recalibrate what is the breaking point for existing property borrowers? Where is that breaking point, taking into account the rise in wages and inflation? Clearly, the breaking point is not where we are now, because we're actually now starting to see some indicators in the Sydney housing market, and to a lesser extent the Melbourne housing market, of a recovery starting to happen. So it's definitely at a higher point. And working out that high point was a large focus of all my effort in putting together our forecast for 2023. And I spoke to a number of non-bank financial executives we know through the ratings that we do on mortgage trusts and the ratings we do on credit, fixed income. And speaking to some banking executives too, and trying to work out what is the breaking point where you would see a lot of forced sale activity in the housing market?
I think this is where the majors go wrong, because I think if you're just looking at interest rate falls and saying, well, okay, we've got, rises, and that this is going to affect the lending rate and this is going to put pressure on households, and you're not taking into account a bunch of other factors that you've just mentioned. So, we have had increasing wage growth, hasn't been massive, but household incomes have actually jumped quite substantially. I think it's about 28%, which of course that's made
a massive jump.
Yeah.
And the other factor too is the rise in employment growth. I mean, look, since we came out of lockdown, there's been over 500,000 jobs created. That's a lot of home loan applications just right there.
And obviously, we've got this pickup in immigration now, which is one of the factors going forward. But I think the other thing is the construction industry. So the ones that really benefited from the home builder grants were the big developers, because the way that the grants were written up was that you had to get like a pre-approval within, a pre-approval and everything done within 3 months, which you can never do on a site. If you're just going to go and employ a small builder and buy a site and want to take advantage of that grant, you can't do it. So it was the house and land packages that kind of made from that. And obviously they're running behind and everything. But in terms of the infill in the suburbs, I deal with a lot of developers, and there's a lot of them that just haven't constructed anything over the last couple of years. And prior to that, they were really hammered badly anyway in 2018 when the commission was going on into the banks because they couldn't borrow. The banks weren't lending easily for development. So, we have genuinely got supply-demand issues right now.
Absolutely. And it shows up in the rental market. And so when you have a situation where, the truth of the matter is that there are shortages of real estate to live in, right? It's really hard to forecast then a major housing crash.
Yeah.
Because I believe this is one of the key ingredients that you need for that to occur.
Yes.
A massive surplus of stock in the marketplace. We just don't have it here in Australia. That is just the reality on the ground. And that's not to say you can't have a major housing downturn, of say double digits, 10 to 15% or something like that. But the 40% type of downturn, I find it hard to model when I'm also forecasting housing shortages and strong migration flows into the country. It's really hard to make those numbers work. So that's not to say it's not impossible. Hey, if the RBA was crazy enough to lift the cash rate to 20%, right, we probably would have it, right? We'd have bigger problems on our hands, I suspect. There'd be riots on the street. But it's just very hard to model that type of scenario playing out when you've got an underlying shortage in the housing market of dwellings.
And the other thing I think I'd say, and obviously, a lot of what I write in the publication is based on cycle research. We look at the cycles, we look at the pattern of cycles, and we forecast the downturns based on that, more so than focusing overly on the fundamentals. But I know myself that when we're coming up to a point where there's going to be a recession or there's something's going to happen to the market, people aren't being careful with their budgets generally. And what I'm seeing with the buyers now and clients that I'm working with is that everyone's very cautious about how much they want to spend. Money is being put aside, money is being hoarded a little bit, to just in case, because no one's really certain about what's going to happen over the next year.
Yeah, that's right. There is, and this is the thing, anyone who buys our report, they'll see my first chapter or my first opening statement is uncertainty is the order of the day. And I was lucky as part of this scenario. So actually, I got to the point of speaking to an ex-Fed member from the Federal Reserve one-on-one. It was really good to get their insights into that in terms of what the Fed's thinking over in the United States and how much uncertainty is there. And the questions surrounding, for example, the fact that we're running this massive real negative rate, despite the rate rises, we've still got a negative real rate of nearly minus 5%. And what does that mean for global economies? And has there been a point in time in the past where central banks have managed to get on top of inflation and still run a negative real rate? And the answer is no, they haven't. Right. So, these are the type of things that create a lot of uncertainty. And in one of our scenarios, which we call false dawn, it's a scenario that plays out where the RBA goes on pause, gets it wrong again. They've understated inflation or under forecast inflation. We have a new inflationary breakout based on, say, massive wages growth. And then later in the year, they have to aggressively lift rates to try and get the real rate into positive territory. But by then, it's all too late. And it creates an absolute nightmare scenario for the economy in 2024. So, Leah, look, uncertainty is the order of the day in a big way. And it just made this year all the more challenging in terms of trying to put our hat on what is most likely to play out.
Yeah, I always think about you around this time of year, because I know myself the pressure it takes to meet deadlines and to write content. So I always spare when you're writing your boom.
It is what it is, and look, I still enjoy putting these things together. People should just always keep in mind that their guides, their forecasts. No one knows the future for sure. All we can do is basically have a go in terms of based on all the information we have in front of us. And of course, at SQN Research, we have a lot of information on housing, which always helps. Speak to some good people that we can trust on the ground, and do some very strong modelling based on what's happened historically in terms of how the markets behaved or reacted to certain events.
Yeah, and this is why your report is so essential, because you don't follow the crowd. You stand against you form an opinion, you stand with that, and you follow along with that. And as we know, and as we've just spoken about, the forecasts that come from the banks, which hit the headlines all the time, are notoriously inaccurate. It's almost as if to me, it's like they look out the window, they see a few clouds in the sky, and they say, right, it's going to rain, and then the sky clears and it gets sunny, and they say, oh, the forecast has changed.
I just wish, Catherine, the mainstream media would sort of hold them to account for all their changes in forecasts that they do. We put ours at the end of the year for the year ahead. We generally don't like doing revisions. We'll just sort of generally admit that we got it wrong if we do get it wrong. And that's the way to roll. I think, putting out revisions all the time or not even stating that it's a revision. It's like, this is a forecast. When you put out a forecast, say, only 90 days earlier. I don't know. I don't like it. I think it sort of lacks accountability. But it is what it is. And look, we acknowledge that forecasting is incredibly difficult for anyone, even for the central bank.
Yeah, it is. I think it's just that, you get it wrong so often, yet it's still a real headline puller,
And that's what they like. They love the headlines. Look, everyone likes headlines. There's no doubt about it. But they do manage to get the headline every time they come out with a forecast.
Yeah, just to rewind it just a second before we kind of go on into, this kind of factors that are facing us ahead. You mentioned that you spoke to someone in the US, about, a bit of inside information about what was happening there. The US at the moment looks like it's going to fall into recession. The economy is not doing great at all. Do you just want to give a bit of insight? Because you said to me, the central banks collaborate more than we know.
I believe they do. Yeah, that's right. Through speaking with certain senior people, I'm very sure they do. We've all been aware that they talk with each other, but I think they talk with each other a little bit more than what we think. And so, just to give an example, of course, the RBA's famed call of no interest rate rises until 2024. Well, guess what? The Federal Reserve made a similar call at the same time. They used the same words. So, what's all that about? That was just really interesting. I mean, and why would a central bank, let alone two central banks, corner themselves like that? Now we get it that they were trying to install confidence in the economies that were coming out of lockdown, but to put a time frame on it was something I'd never seen before in a central bank. But yeah, look, the view is that they talk quite a lot with each other, I don't know whether they go so far as to try to coordinate with each other, but quite clearly the Federal Reserve, it's probably the most powerful central bank worldwide, and their moves on the cash rate can have an impact upon the Australian dollar, as an example. And in a worst case scenario, the RBA is then forced to move to try and protect the dollar one way or the other. They've got great bearing across the global economy. And I'm speaking of the Federal Reserve.
Yeah, and that's the worry, because, obviously the yield curve's inverted. We've got that, occurring in the US. It's there's a lot of talk about them potentially going into recession next year. We're in a much better position. But, America's economy, as you say, has a huge influence on what happens globally and, particularly, what happens to us. And that's obviously was taken into account with your forecast for 2023.
Yep. Yes, absolutely. It was taken into account of our forecast for 2023. So if you like, I can talk about the forecast now.
Let's get to it. I've spent too much time chatting on. So I don't know what it is yet, but we had a bit of a chat. I think your baseline, because I said to you on the phone, look, things aren't looking that bad on the ground. For me, turnover's improved, clearance rates are coming up. There's buyers that are out there. There's activity going on. The major discounting from vendors has happened. And now there's not that much discounting going on. There's poor listings out there, but generally the stock is turning over at an expected price.
Yes.
A bit of negotiation going on, but it's looking pretty good. And even in the regional areas, so I do a lot of buying in the bigger regional towns, and turnover has really started to pick up there. And my clients, there are a range of clients, but they're generally investors. So I've got, cash buyers that are on the books at the moment that are buying in that kind of $500,000 to, $800,000 price range, buying in cash, reaping from the yields. That's what I'm seeing on the ground. And then you said, well, your base case actually isn't that bad. And you thought that I'm going to get some flack for this, you said to me, right?
Yes, I will. So because we're forecasting a modest to moderate housing market recovery in 2023, driven by a recovery in the Sydney housing market. So the forecast we have overall is that capital city housing prices will rise somewhere between 3 to 7% over the course of the year, with Sydney and Perth being the outperformers. So we've got Sydney forecast to rise between 5 to 9% and Perth rising 4 to 8%. I might as well share the screen now, if you like, with your audience,
sure,
Evan, so we can see the base case, we can see our scenarios and what the assumptions behind them are, which is really critical.
Yeah.
Okay.
And we'll start with the base case and the assumptions around that, because obviously it's going to sit against, once again, what the majors are saying. Is that coming? Oh, there you go. Fantastic. Amazing.
You can see the table?
Yeah, I can see the table. Okay.
Excellent. Okay.
So obviously it's going to sit against, what the majors are saying. But what will surprise? I think everyone can kind of look at Perth and say, okay, WA Perth in a better position. Obviously, they're reaping from what's happening to commodities. It's easy on them for the gas prices. They've got population growth going on there. They've got wage growth going on there. They've got a real problem, rental rises and that. No one is going to be expecting someone to come out and say Sydney's market is going to also lead. So what's the reasoning that you've got around that?
No problem. Yeah. So as mentioned, our base case is that Sydney housing prices rise 5 to 9%. So why have we said that? There's a number of factors. Firstly, we believe that there's going to be an increase or an expansion in underlying demand for accommodation, albeit whether it be rental accommodation or for sale accommodation or owner-occupied accommodation over the course of 2023. That rise in underlying demand will be driven by an increase, and we're seeing it now, in overseas arrivals wishing to stay longer term in Australia. And historically, their first ports of call are Sydney and Melbourne. So that's the first factor. The second factor is a return to the office. And we are seeing it now. We think it will continue into 2023 in earnest, where people have been living in the regions will be coming back into the cities to live. And so that's been already starting, and we believe it will continue on in 2023. A third factor with this is the recent change in the taxation policy of the New South Wales state government when it comes to stamp duty and land tax, which, as you may well be aware, there's been a change which is now in play, where first-time buyers essentially can go and buy a property right now, not pay any stamp duty, up until $1.5 million, that is. And they can offset that against a land tax that goes over multiple years. And that will mean quite a significant saving for first-time buyers. And let's remember who a first-time buyer is. Normally, a first-time buyer is a renter. And one of the other factors in all this is the ongoing rise in rents that we believe will occur in at least the first half of 2023 for the Sydney housing market. So we believe it's still a very tight rental market, but we do believe the rental market will peak in Sydney and other capital cities in the later half of 2023. And we can talk about the reasons why for that later. But then going back to Sydney, the other factor of this is the strong Sydney economy. And I don't think this is talked about that much. And the fact that, okay, we could have a recession in the United States, but given our connections to the tiger Asian economies, I believe that our economy will actually withstand such a recession in the United States to an extent. But we definitely got that as a tailwind in our economy. And Sydney in particular has a lot of exposure to the Southeast Asian tiger economies. So we're talking about strong economy, strong population growth occurring. We've had a little bit of a correction in the market, so affordability has improved somewhat. Values have improved somewhat. It's still expensive in Sydney. There's no question about that. Then we need to consider some of the leading indicators that we're seeing on the ground right now. And as you know, Catherine, we measure auction clearance rates, and our series is regarded as being one of the more conservative ones. It's also regarded as being one of the more accurate ones. And one of the things that we've picked up during the current spring selling season is definitely a rise in auction clearance rates, particularly in Sydney's eastern suburbs. This, of course, for those who are not familiar with Sydney's eastern suburbs, it's essentially the more affluent part of town. And we've noted, not just with the auction clearance rates, but with asking prices, a rise in vendor confidence in Sydney's eastern suburbs. Now, this is an area that historically we've seen in the past where you've got, it's a market where prices actually can rise during a rising interest rate environment. It normally happens when you've got a surging local economy. And it goes to our point about this notion of people looking for hedges against inflation, and this notion of the fact that, wages may not be keeping up with inflation at this point in time, but they are picking up. But importantly, the recovery in the small business community in Sydney has been quite amazing to watch. And that has generated strong income. And many business owners are in a position, despite the rate rises, to buy property, many of them just buying outright cash. So this goes to the heart of the reason why we believe the Sydney housing market will pick up. Just some of these tailwinds we speak of and some of the leading indicators we're seeing now suggest that a recovery may well actually be starting to take place, at least in some parts of Sydney.
I have a friend that's just purchased in the eastern suburbs of Sydney, and he wrote me an email when he started looking. He said, don't believe anything about, the market being dead here. He was being run up against buyers a lot and ended up paying more than he expected to.
I'm not surprised by that, because we've been recording auction clearance rates in the 60s for Sydney's eastern suburbs. And as you know, Catherine, look, we've got a conservative clearance rate. So a clearance rate in the 60s is actually relatively high for us.
Yeah, it is.
And this is happening in the spring selling season, typically a time when you see auction clearance rates actually fall.
Well, it's interesting. I've seen you say that on Twitter before. I mean, in my experience, there's a bit of a pre-Xmas rush from buyers that want to get in prior to the holidays. And then, obviously there's a lot of push from sellers that want to sell prior to that January lull, because people tend to go away, and there's no auctions, and the market, tends to go a bit quiet over that period. But yeah, I mean, the interesting thing about clearance rates, and I, each week I tweet out domains because they come out. You don't come out with the prelims, you come out.
No, we come out with our finals on Tuesdays,
which is fair enough. But the way that I kind of see it is that it's the percentage rise is a leading indicator of what's happening to the market more broadly. So if you're seeing a percentage shift in the clearance rate, even if the data is dodgy, which we know that it is, and not all the results are reported and everything, but that is a good indication to me that markets are looking a little bit better. And then obviously, looking for more accurate consideration of what's going in when your clearance rates.
Well, that's right, Catherine. And the reality is that if we were having a housing price crash, we wouldn't see clearance rates start to pick up in spring. Just wouldn't be happening.
Yeah. The return to the office is interesting to me as well, because, I've had quite a few conversations around this. The office in Melbourne, it's still struggling a little bit. It doesn't, it's obviously better than it was during the pandemic, but things have shifted a little bit, don't you think? I mean, there's much more of a hybrid model going on. There's, people aren't necessarily expected to be in the office as often as they used to be. And what I'm seeing is that, commutes outside the city, I've seen a lot of people, for example, move to Geelong, which is only an hour's commute from Melbourne.
Yeah.
And commute backwards and forwards, as long as they're not having to do it every day. That kind of like hours distance is still, picking up population growth outside of the cities, because it's considered that you've still got an easy commute there. Are you saying that you think that, people are going to return to the office sector as they were before, or do you accept that it's going to be more of a hybrid?
Yeah, I think it will be more of a hybrid. Potentially you could see a gradual move to, say, 4 to 5 days a week, whereas I think largely now many groups are somewhere around 3 days a week. So I think in time it may well move more back to the office. But I don't think we're going to completely go back to 5 days a week. I think that's very unlikely, and I believe that there is permanent change there. But we need to see what happens in the next recession, where we see, say, far higher in unemployment. At the moment, if you consider the labour market, you would have to say that, let's call it sellers or Labor's got control of the market. Okay, they've almost cornered the market given how low unemployment rates, and employers, therefore, haven't got exactly a lot of bargaining power going on right now. And so many employers risk the situation that if they force their employees to go back 5 days a week, they could lose staff at a critical time. And so there's been a give and take. Now, I suspect when we go into the next major cyclical downturn, we could see a situation where employers say, all right, well, I'm going to hold the line here now. I'm going to ask my staff to come back full time, or I'm expecting to come back at least 4 days a week. And so we could see that play out. That's a difficult one. But yeah, I still believe, though, that we are the return to work coming back from, say, 0 days in the office. And I'm still aware of many people who are still, they can decide at their discretion whether they want to even come into the office at all. Like my wife, for example, working for one of the major banks. There's still a fair degree of people out there not even coming back into the office yet. So we're still going to see this phase. We're still in this phase now of returning to the office. It's still happening as we speak. It hasn't stalled yet. So there will be more people coming into the cities.
And just want to touch on in that forecast as well, when you talked about the switch from stamp duty to land tax. I mean, obviously I'm president of Prosper Australia. We've been campaigning for this for a long time. And we knew that initial switch would have an inflationary effect on the market, because you don't need to have 30, 40 grand or whatever at a minimum. I mean, in Victoria, the stamp duty is higher, I think, than anywhere else in the country. Obviously, that's going to be in your pocket and enable you to bid up prices a bit more. It's bound to have an effect. If it has an effect on the lower end of the market in Sydney, obviously that's going to cause kind of like a price wave effect across the other areas of the market as well.
I'm glad you said that. That's right. So one of our forecasts is that we still expect overall in Sydney that units will actually outperform houses like what they've done this year. I think, the patchier part of the market for 2023 will likely be these freestanding houses between $2 and $4 million. I still think it'll be relatively patchy, but we should see a pick up more in the unit market and the top end of the market definitely moving forward. And going back to that $2 to $4 million mark, yes, I say patchy, but I think the prices will stop falling.
Yeah. And don't you think that the other states, I think the other states there's a real probability that as they see what's happening in Sydney with that switch, that they will follow forward. Yeah. We've seen it in Canberra, what's to stop Melbourne, for example, doing that?
Yeah, that's true.
We got through the election. And
that's it, though. You'll see that, our forecasts for Melbourne are a little bit more muted. We're forecasting next year on our base case price rises of 1% to 5%. So we're being a little bit more conservative. That's simply based on some of the leading indicators we've got. Like we're seeing a little bit more stock in the market than, say, for example, Sydney, as one of the factors that are there. The price falls have not been as great in Melbourne compared to the Sydney market as well this year. So Melbourne's actually held back. You may say, well, that should mean Melbourne should outperform. Yes and no. And also with Melbourne, we've got a larger interstate migration outflow occurring. So there's a bit more of a leakage coming out of Victoria compared to, say, for example, New South Wales.
Yeah.
Well, certainly that's our forecast.
Yeah, that kind of leakage going north, right, into southeast Queensland. Correct.
So I think those factors, plus, of course, Victoria hasn't come out and stated that we're going to do a stamp duty for land tax swap.
Yeah.
So that there's been no such policy announcement. And that's definitely been one of the key factors which has influenced our Sydney forecast.
Yeah, we've been pushing for it with the Treasury in Victoria for some time. So we know that there's understanding for it. Whether it would ever be, put into policy, I don't know, but we'd need to wait and see. But let's get on to the other scenarios, because I think these also are just as important in recognizing what might be ahead in 2023 and what we might have to look out for. So talk us through your next, scenario number 2.
Yeah. So the Goldilocks scenario. So this is where, this is like the perfect world if you're a property investor. And that is a situation where the cash rate doesn't go over 4% and the RBA actually starts cutting interest rates in the second half of 2023.
Which some people have suggested that they might do.
That's correct. And that there's a little bit more movement on inflation. The inflation sort of peaks at roughly around 8%, comes back to roughly around 5%. Unemployment rises but stays below 5%. So it's a more softer landing in terms of softly compared to our rates on hold but no rate cut scenario, or rate cuts only occurring in say, for example, this time next year. So in that scenario, the forecast would be that dwelling prices would rise a little bit more strongly at 5 to 9%. There'd be more confidence in the economy, and though inflation is still elevated, the RBA would still feel comfortable to the point of cutting rates somewhat, because their expectation would be that we'll see basically inflation return to 2 to 3%, or their target in 2024. So that's a Goldilocks scenario. So on balance, and look, to be calling it straight, we've been loggerheads on all these scenarios. Our scenarios for 2023 have been a close run thing. There's no massive standout like what we had in 2022. That these things were all pretty close run. So Goldilocks was our scenario number 2. Then scenario number 3 was one where, we were thinking this could actually really play out until I had some more recent conversations, but it still made our top 4, and that's the false dawn. So this is the one where the RBA goes on pause, but they've erred again. They've made a mistake in doing that, and they've they've basically understated their view on inflation, and there is a new inflationary breakout. There's a bit of a precedence for this. We had this happen in the 1970s.
Okay. Do you want to just explain what happened at that point?
Yeah. So look, there was an initial inflationary breakout in the early 70s, 1972 to 73 in particular. The central banks at that time did lift rates, went on pause though a bit too early. And then in 1975, there was a new outbreak. And that was driven by basically wages really spiraling upwards. And so then, that was a point when we actually had an inflation rate of 17.5% in Australia, from where it was like initially it was getting up to about, 10 to 12%. It boosted right up to 17.5% because the central bank at the point in time just basically essentially went on hold a little bit too early. So, yeah, there's precedence for this. And that's a real scary scenario because it would probably mean for 2024 a real hard landing because you've got essentially a panicked Reserve Bank of Australia realising they've made it yet another error in policy. And so then they go aggressive. They seriously go aggressive, and they realise that they've got to put the cash rate into real positive territory after all. And so they lift aggressively from later 2023. So that you'll see in that scenario, okay, yeah, the forecasts are kind of more muted. It's not a crash because the crash is yet to play out. The crash kind of really plays out in 2024.
Correct, yeah.
Because all the effects of going that aggressive play out in that year. So, yeah, that's the false dawn scenario.
Spoke a bit about that on the phone, and you were saying, I think it's kind of back to that you're erring against that not necessarily happening. You think that they're keeping on top of where things are right now.
Yeah, I think some of the differences between, say, the 1970s and now, look, there's more information. There's more timely information. So, for example, we know when it comes to rents that the ABS series is lagging asking rents, and the RBA has made it perfectly clear that they're aware of that situation. And so what that means is they're taking this into account, that they expect that lag in the ABS measure of rents will play out over the course of 2023, which will affect the CPI. So they're aware of that situation. So I think their information has improved over time. And yeah, I'm basically stating in our scenarios that we're thinking that the RBA will actually manage to walk the tightrope. They talk about a tightrope they're on. I agree they are on the tightrope. But I think the probabilities have just increased more recently that they may well manage to pull this off. Look, everyone knows they've got egg on their face given their call about no interest rate rises until 2024. Let's just say that they are hell-bent on trying to restore their reputation. And restoring their reputation would look along the lines of creating a soft landing for the economy. That's what they want. I'm sure that's what they desperately want. And so I'm sure there's even more effort into analysing the data and being very conscious of their policy decisions and what they state out there to the media. I think that they've maybe learned some lessons, and this will help us get back to that softer landing scenario. But we cannot rule out the false dawn scenario. It could very well play out. And we know that the ABS is measuring wages. So the measures of wages come from the ABS. And I have some concerns about that because I don't think that their measure of rents is particularly that great. So we'll see what plays out there. And then, of course, our final scenario, which is a recessionary inflation scenario. So this is where the RBA doesn't go on pause. They have to keep lifting rates, and they live to what they've stated, where it's like, okay, we're going to lift interest rates until something breaks. You've heard a fair bit of this language from the Fed. So, look, my inside info on that is that is a lot of jawboning. And essentially, look, they don't really want to necessarily do that. They want to try and time this right. But of course, by putting rates on hold before the real cash rate gets into positive territory, they risk scenario 3 from playing out. And they know that. This is the thing. They know this. They are aware of the risks. And that kind of gives me a little bit of more confidence that, look, they may well just pull off scenario 1.
And also that kind of jawboning about it puts caution within people anyway.
That is correct. And that's what they want. They want the caution. They want the slowdown. They want the pullback in demand to occur, but they don't want it to pull back too much. Otherwise, they get a hard landing. I wouldn't want to be a central banker right now. I'm sure many people have said that.
You want the wage that they get paid.
Yes.
It's interesting to know how much work goes in. But I wanted just to make a comment about the rents because,
yes.
Obviously we know that there's rises that are coming, but there's also been a lot of talk. And again, this is from, some research that we've done at Prosper on the short-term rental market, which it's crazy how everything's played out in the short-term rental market because we had, during the pandemic, that market was obliterated.
Yes.
And a lot of the short-term rentals became long-term rentals. And, I was having a chat with Pete Wargent, did an interview with him the other week.
Yes.
And I was saying that I was having conversations with agents at the time, particularly in the city and particularly in Melbourne, that was hit really badly, who were saying it's a rental apocalypse. We've never seen anything like it. There's just like a flood of supply. And you couldn't tenant a property. Like, who would have thought? Here we are, in 2022, and it's completely the opposite. You can earn a lot more income now from a short-term rental. There is a shortage of them in certain areas.
Yeah, that's exactly right. And very few people are actually aware that, we've had a situation in Melbourne and in Brisbane where there's actually more short-term rental properties on the market than what there is long-term properties on the market. Quite an extraordinary situation.
Yeah, but kind of on the back of that, what's been happening is that is the questions about, well, what are we going to do in terms of policy to stop that? Now, the short-term rental market is actually very difficult trying to create policies around it and then regulate those policies. It's a bit like trying to create policies around, we're going to tax vacant housing. How are you going to tell the properties are vacant? We'll have this self-reporting system or whatever. I mean, there's ways and means of doing it, but it's quite difficult. But if they were to do that, is it going to have a substantial impact then on rentals, or is it going to be offset regardless anyway with immigration coming in? Although bearing in mind that most of the migrants that are coming in from overseas are going to flood to the cities of Sydney and Melbourne probably.
Well, they are. That's a very good question. Our forecast for rents next year are that rents are actually going to increase in the first half of the year, and then we're actually going to see a peak in the capital cities in the second half of the year. Yeah. Eventually, Catherine, everything gets priced into the markets. The housing market's actually a little bit more efficient than what people give it credit for. And we, as you know, we've had very strong rises in asking rents. I believe that on any economic slowdown, we're actually going to see a flow from the short-term leasing market back into the long-term leasing market. If you were to see a slowdown in the economy, that would mean less travel, less people taking holidays, less overall business travel as well. And that's what the short-term leasing market counts on. You could argue now that there is actually a surplus of rental stock in the short-term leasing market, given what we know of the market right now and how many properties are available for rent. It's literally at the point where your standard suburban home is the property owners thinking they're going to get a better rent, putting their standard suburban home into websites like Airbnb.
Yeah,
and it's like, okay, that's interesting. I think we're near the peak of this phenomena at the moment, and so I think there will be a flow back, regardless of, say, any state legislative action on Airbnb. So the forecast is we do believe that rents will peak in the capital cities later in 23, not the first half. There's still all the evidence suggests rental market's still moving forward, at quite a clip.
And the other thing, the factor of playing in that is if you're saying that we've got, and there's indications of this in the rental market anyway, with what's happening with the vacancy rates on a micro level, but, you've got people moving back to the cities. Yes. And moving back to the office, then obviously that's going to continue that pressure on city rents in the shorter term, right?
In the short term, that is correct. And that will continue on. And we are seeing, and that I've put out some public statements about this, that, we're seeing now a rise in rental vacancy rates in some regions, the regions which, we saw record low rental vacancy rates during the lockdowns, during COVID. For example, the Blue Mountains, Sydney's Blue Mountains.
Yeah.
We're now recording a rise in rental vacancy rates, and we're recording a fall in rents. Now, for those who are not overly familiar with Sydney's Blue Mountains, that's about 2 hours away from the CBD. So, it's, in the scheme of things, given all the regions around Australia, it's relatively close to Sydney. But, it's still a fair distance away from the CBD itself for people to, really sort of get a bit narky about getting up in the morning and travelling all the way into town. It's we are seeing a bit of an easing there. And this is the thing too, that as a result of that, I'm a little bit more concerned about prices for regional Australia in 23. I think we're starting to see a little bit of a correction now. The issue is that with many regional townships, they can be boom-bust towns. They don't generally have a lot of liquidity about them. So if you consider a standard capital city like, say, Sydney or Melbourne, in a downturn, you still have liquidity. You still have buyers there in the marketplace, even in the worst of times, right? But in these regional townships, as we've seen with the mining towns of the past, when the downturn comes, it can be quite severe.
Huge falls in those areas.
And that's what I'm concerned about, because we've had some mega rises in these regional townships due to the lockdowns, due to COVID. And yes, look, there will be people who want to stay. They've managed to pull off the lifestyle, the tree change. They've managed to pull it off, or the sea change. That by and large, I think we are seeing this flow back to the cities.
It's really interesting, and it kind of goes with what I've been seeing on the ground. People wanting to be, they'll go further out, so they'll to buy something that's a bit more affordable, but not too far out. And so what I want to kind of know, with everything that you've been looking at now, and also kind of based on the conversation that we had in April, what would your advice be to property investors from now? Like, is it you get into the market still?
Okay. So up front, our forecasts are a guide, and I've stated up front that I don't have a lot of confidence this year that our base case is actually going to hold out. It's just on the balance of probabilities. Any of these four scenarios could easily play out, far more than, say, I've had in previous years. What this all means is that we've got an uncertain environment. It's an uncertain environment, so you need to play uncertain environments cautiously. Caution is the order of the day here. I still believe that real estate is a good hedge against inflation, even while we've got relatively high debt to GDP levels. But I wouldn't want to be taking out lots of debt. I just wouldn't want to do it. Yes, as you know, I stated earlier this year, get your hedge in against inflation. That's important, but don't be too aggressive about it. And I still stick to those views.
Yeah, and that is exactly what I'm seeing with buyers that I'm dealing with. I don't think anybody is going out there and not taking into account uncertainty that's going on in the market and the prospect of everyone's forecasting the cash rate, and it is in the shorter term. Obviously, we've got to expect that that's going to continue to rise.
Yeah.
But in terms of the overall major sentiment on the ground, it is not as bad as is being made out.
Yeah, that's absolutely right. It's not as bad. And we note that our clearance rates, when we look at Sydney and Melbourne and Adelaide, they essentially bottomed out from mid-year. And as mentioned before, that's not what you see in a housing crash.
Yeah.
Brisbane, on the other hand, I'd have to say there's more leading indicators that just suggest that, look, we're not at the bottom of the market yet in that city.
And what would those be?
So, the auction market itself, and you've got to be careful of that because you get lower volumes. We're recording very low auction clearance rates in Brisbane, and the trend, which is like we like to follow, has actually still been heading south. We're seeing a rise in stock listings. We're seeing a rise in distressed listings as well. And, that's a more recent index that we've got out there. And that's definitely been on the rise in Southeast Queensland. We don't think Brisbane's heading into crash territory by any means, but it's just a market where, you look at the leading indicators, they're not particularly as positive as what we're seeing, for example, in parts of Sydney and Melbourne. That sort of put some caution into me. And then on top of that,
right.
So
well, they have the backflip from the taxation changes that they were going to,
Yeah, correct. So the other thing too is that the Sydney Brisbane price gap has narrowed. So whenever someone moves interstate from, say, Sydney or Melbourne to Southeast Queensland, they generally get a standard of living uplift because housing prices are more affordable in Southeast Queensland compared to Sydney and Melbourne. Yeah. But there are times when the price gap narrows right up.
Yes.
And we're in one of those times now.
Yes.
And so that will make people just think twice about doing the move.
Yes. Yeah, you see that on a suburban level as well. You see that within cities as where you kind of get that flow outwards. And then once the prices catch up in those places where people have been moving out, the flow kind of does a little bit of a reverse, and then people start, increasing the budgets marginally and coming back in. So it's of course, it's interesting to kind of hear that. But
we're not overly bearish on Brisbane. Long term, we're probably a little bit more bullish than bearish. We note the Olympics. That's coming, and there will be jobs as a result of that. There will be excitement about coming to Southeast Queensland. I think for 23, we're likely to see outperformance in Melbourne and Sydney, really compared to, say, Brisbane, in my view.
Yes. Yeah. Very interesting. Thank you, Louis. We're almost out of time, and I want to give your report a bit of a spruik because, and I said this to you when we had a chat on the phone, and I really, truly believe it. I think it's the best report out there for anybody that wants to get some kind of certainty or insight of what's happening on the markets, because it's incredibly comprehensive and it's affordable. It's what, $60, $59?
Yep, that's right.
$59.99, something like that, just at 60. But it goes over all the major and minor markets throughout Australia. It has a range of indicators. Obviously, you have your own in-depth analysis that you go into within the report, your scenarios. It has a record of accuracy now that has built up over the years. And, for anyone out there that is an investor, and of course, I say a lot of the time to my subscribers as well, this is also important for stock market investors to understand what's going to happen to the economy, because obviously Australia's economy is very exposed to the property market. The stock market carries a lot of economic rent from the banking sector, building companies, land and what happens to the property market really is a big influencer on the economy. So understanding what's going on and diversifying your investments and particularly getting a bit more knowledge of the areas and the different suburbs across Australia is essential.
Yeah, absolutely. Thank you for that. Yeah, thanks for the plug. The report itself goes right down into the postcode. So we provide a lot of individual information down to the postcode level, including our ratings that we've got, which are more like risk scoring of localities. And then, that's what we keep for the report for those who pay for the report. We talk about our high level forecast for the cities, but the report is really predominantly about all that data that we put into the report on the postcodes.
Yeah, and because anyone that wants to get a little bit of access to that data, you also provide a lot of free data via the SQM website, which is, from my perspective, it's invaluable from the analysis that I do on the markets. And so, I think that you're doing a good service for Australia in general.
Yeah, thanks for that. We intend to sort of keep a lot of free data there. Unfortunately, we found some institutions taking advantage of that, people who should be buying our underlying data. So we might have to make some changes, which will just tighten that up a bit, The community can access what they want, but the institutions, well, look, hey, they've got a budget. They should be paying for some of this underlying data.
Yeah. Well, when I ever attempt to go to CoreLogic, which again, I do kind of through Prosper Australia, we have to collect a lot of data through that, and they charge thousands and thousands for it. And it basically puts it behind lock and key, and you can't do effective analysis on the economy because, what should be accessible to enable you to make an educated decision moving forward isn't accessible to a lot of people. So, I mean, the service from that perspective is pretty valuable.
Thank you, Catherine. Thank you.
No, you're welcome. Thanks, Louis, for coming on. Much appreciated. Let's see how, the months play out.
No problem. Feel free to, we can tune in later in the year and we'll see how the forecasts are playing out.
That would be great. That would be great. Thanks very much.
Thank you.
Thanks.